Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst for Equity Capital. I'm based in London, and Equity Capital is one of the many companies within the overall equity group, which include Equity Nigeria in Nigeria and, of course, FXPesa in Kenya. And now, for those of you who have not been to one of my webinars before, the rundown is I'll run through 4 or 5 of the major markets, talk about what's going on in terms of fundamental analysis, news, what's driving the markets, what are the major headlines, and I'll also analyze the markets from a technical point of view. For those of you who are relatively new to the financial markets and new to trading, technical analysis, the study of charts, is an area of trading or analysis I find really interesting, and I found it really helpful over the years. So I strongly advise you taking a look at that. Everyone has their own kind of opinions. Some people are more of the fundamental analysis school of thought. Others are technical. Some people are kind of follow both schools. So what I'll do now is I kick off with euro dollar. The currency pair has had a fair bit of volatility today, given the European Central Bank's interest rate decision. Just to let you know, I'm looking at a 4-hour chart. That'll be the standard time frame that I'll be looking at for these charts. Yes, I might flick between an hour chart and a daily chart as well, but by and large, I'll be mostly concentrating on 4-hour charts. I do have 3 moving averages on my screen here. This is the 100 period moving average, the 50 period moving average, and the 20 period moving average. In terms of indicators, I have the MACD indicator here, moving average, convergence, divergence, which essentially kind of measures kind of momentum, essentially the rate of change, and the RSI, the relative strength index, essentially is kind of a measure, kind of almost like elasticity. How quickly is a market, is a market being overbought? Is it being oversold? Is it being overstretched in either direction? So looking here at euro dollar, so we can see here a lot of volatility in the last few hours. Well, what's been behind this? Well, the European Central Bank hiked interest rates by 50 basis points, or 0.5%. It caught some by surprise. It wasn't a total shock, to be perfectly honest. In the last few weeks, the European Central Bank gave pretty strong indication that they're going to hike interest rates by 25 basis points. Earlier this week, though, a report was announced stating that the ECB are going to consider a 50 basis point hike at today's meeting, and lo and behold, a 50 basis point hike is exactly what they delivered. So it was a bit of a surprise. It wasn't too much of a surprise. But at the same time, the European Central Bank also announced the transition protection indicator, the TPI, which basically is a way for the European Central Bank to keep purchasing government bonds of indebted countries as a way of keeping yields under control. So the TPI acts as sort of a new stimulus package if required. And with that, people were looking at this policy and going, well, you're hiking rates, but at the same time, you're also giving yourself the wiggle room to actually purchase government bonds, which is essentially quantitative easing, which is a form of loosening your monetary policy. So on one hand, they're tightening their monetary policy, hiking interest rates, but at the same time, they're giving themselves the option to loosen policy at the same time. So it's almost a case of 2 steps forward, 1 step backwards. So on one hand, we had a very sharp move higher in the euro because of this, and then after a while, when people started talking about the TPI and the likes, I started realizing that perhaps this isn't going to be absolutely as hawkish as originally seemed. Then I got the impression that maybe we're not going to have the kind of the massive powering ahead in the euro as was originally predicted. Also, what's in the mix as well is that in the bigger scheme of things, we need to be mindful of the fact that many of the Eurozone countries, such as Italy and Greece and Portugal, are fairly high levels of debt. So in an environment where interest rates are rising, that usually pushes up government bond yields. Government bond yields, of course, is essentially the rate of interest governments have to pay to borrow money. And if you're someone like Italy and you have a fairly large amount of debt, higher interest rates, higher bond yields means it's going to put more and more pressure on your economy. So this is why the European Central Bank have this kind of get out, the transition protection instrument, the TPI, as a way of actually saying, oh, we are going to hike interest rates, but if we do feel the need to buy certain government bonds to keep yields down, we will do that. So today's move and the more kind of medium-term upward trend needs to be taken into consideration of the fact that the much longer-term trend for the euro is to the downside. Euro dollar hit the slowest level in 20 years only about a week ago or a week and a half ago. So the big picture trend for euro dollar is higher, although we did see a fairly decent bounce in the medium term here. We haven't really we haven't even gotten close to 103 yet, or up towards 103.24. So while we continue to hold below these two simple moving averages, the 100 period and the 50 period moving average, it's likely that the longer term downward trend will remain in effect. So taking a look at the MACD indicator here, we can see momentum has swung from positive territory to negative territory, indicating that the bears are now in control. There's a sharp move lower in RSI as well, the relative strength indicator. So when that's moving lower, typically it means that the price bias is to the downside. So if we do see continuation in the short-term downward move in price, where could we go? Well, I think we could potentially get back down towards this area here at 1.0027. On a break below that, could see us down towards 0.9951. Now, like I said, we have seen a lot of volatility in the last 24 hours, and particularly the last few hours. On one hand, we seem to be trading in a bit of a range on euro dollar. We seem to be holding above this moving average here for the time being. But at the same time, we haven't really made any gains above the recent peak. If we can manage to hold above this moving average here, which comes into play in or around this zone here, in around 1.0165, if you can manage to hold above that area, that could be an early indication that the more medium-term upward trend is going to continue. A rally from here could see a target 1.0324. And a break above that could see a target 1.0448. Now, when I was talking about this chart, I know I spent the bulk of the time talking about the euro. The second half, the other component of this currency pair, of course, is the US dollar. Now, the US dollar, we have seen a bit of a pullback. A week ago or just over 10 days ago, we saw the US dollar index at a 20-year high. But since then, we've seen a bit of a pullback in the dollar. And why is this? Well, to a certain extent, there's a belief that the Federal Reserve, who have already hiked interest rates a few times, they're looking at doing further rate hikes this month and also in September as well. But there's a belief that perhaps the Federal Reserve won't be as hawkish as originally feared. Also, there's some slight rumblings about the US economy, either potentially enduring a large slowdown or potentially even moving into a recession. Looking at today's economic indicators, the US jobless claims rate, which is essentially a measure of people claiming unemployment benefit, that increased to a 6-month high. And second of all, the US Philly Fed manufacturing report dropped to its lowest level in over 2 years. So there are ever so slight signs that the US economy is weakening. That would typically mean the domestic currency would lose a bit of strength. So it's not just all about the euro today. The economic indicators out of the dollar needs to be taken into consideration too. And speaking of the US economy, looking here at the US 500, the S&P 500. So we can see here that the last few sessions, the US 500, the S&P 500 has been driving higher. In fact, in the last few hours, it hit its highest level since early June. So we're talking about almost a 6-week high on the US 500 has been created. So that really kind of speaks to how bullish the recent upward trend has been. What's going on with this? Well, there's a couple of things at play. The US 10-year yield is kind of like the main kind of government bond yield that traders and investors look at. And although the US 10-year yield is much higher than that, as say the German 10-year yield or the French 10-year yield, it's fallen back a bit. It's in around, the last time I saw it was in around 2.94%. Keep in mind, we've been as high as around 3.48 in the last few weeks. So we've retraced a small bit. And why is this? Well, I said a few minutes ago, there's speculation that the Federal Reserve might not be as hawkish as originally feared. They are hawkish, but it's to do with what degree of hawkishness will they pursue when it comes to hiking interest rates. So what we had a period here, well, in mid July, but also in mid June as well, when sentiment was when traders were very fearful that the Federal Reserve would be very hawkish. That led to a sharp downward move in stock markets. But now that people have gotten used to the idea of higher interest rates, it's become part of the more part of the mindset. There's now kind of a feeling that, perhaps the Fed won't be as hawkish as originally feared, and in turn we're seeing a move to the upside in the US 500. If you do manage to continue above these three simple moving averages, it's likely the more medium-term upward trend will continue. A move higher from here could see a target this zone here at 40.30, and a break above it could see a target this region here at 40.96. Taking a look at the price action in the past 24 to 48 hours, we can see the market continues to move higher. But if you look at the MACD indicator here, which measures momentum, we can see there's a clear decline in positive momentum. So it's almost as if the buyers are running out of control, running out of steam. So when you ever see divergence between the two, a decline in positive momentum, but yet the price keeps going higher and higher, that can be an early indication that a change in trend is in the offing. Doesn't always work. Like anything in trading or technical analysis, there are certain common things which happen sometimes more often than not, but nothing works. Nothing works all of the time, and that's why trading is difficult. But if we take a look at the RSI here, we can see it's close to the overbought territory. So it's close to overbought territory. It's almost, which is like saying that the rally could be kind of overstretched, overcooked. Also, could act as a kind of flash warning to say perhaps this recent upward move has kind of run its course for now. If we do see a bit of move to the downside in the US 500, where could we go? Well, we could look back down towards this simple moving average here, which comes into play at 39.22, and a break below that could see us back down towards this simple moving average here, which comes into play at 38.28. Coming on now to gold. So I talked about how we saw a lot of volatility in the euro today, and the most liquid or heavily traded currency pair in the entire world is euro dollar. So the euro versus the dollar. So whenever you see a large move in euro dollar itself, in this case driven by the euro, you also typically see the US dollar being impacted not only against the euro but also against other currencies. So in today's session, at one point euro dollar was down heavily, and in turn the dollar was weak across the board. It was weakened against the British pound, the Swiss franc, and the likes. So when you're ever trading gold, you need to be mindful of the fact that gold is traded in US dollars. And not always, but more recently, it's been fairly common to have a fairly strong inverse relationship between the US dollar and gold. These relationships don't always remain forever, but they come and go. But recently, there's been a strong inverse relationship between the two. So whenever we've seen periods of a strong US dollar, which is until the last few days, as I mentioned a few minutes ago, last week, the US dollar index at a 20-year high, that coincided with a sharp move to the downside in gold. Now, even though in the last few sessions, we have seen a bit of weakness come into the dollar, that really hasn't corresponded to an upward move in gold until now, really in the last few hours. So even though gold has rebounded somewhat, it's still holding below these two simple moving averages, the 50-period moving average and the 100-period moving average. Once again, to remind you, I'm looking at the 4-hour chart here. So while that metal continues to hold below these two simple moving averages, it's likely the longer-term downward trend will continue. A move lower from here could see it retest 1700, a big psychological number, and then below that down towards 1680. If you take a look at the price action in the past 8 hours, we can see a sharp turnaround in the price of in the price of gold. If you take a look at this candle here, the body of this candle here completely engulfs the preceding red candle, which is a negative candle indicating the market fell in that time frame. So this candle here itself could be, no guarantees, but it could transpire to be a bullish reversal, meaning which is typically a sign the market's going to rebound. Now, even if it does rebound, will the rebound last for a few hours? Will it last for half a session? Will it last for a full day, or will it last for a week? We don't know. Or even if it does rebound, in order for us to be confident that a reversal has taken place, we would need to see the price move continually move higher from here. You can't just reverse and then say it's a reversal. You have to actively move higher. So it has the potential to be a bullish engulfing or a bullish reversal, whichever what you want to call it. If in fact it turns out to be a bullish engulfing and a bullish reversal, and we do look to rally from here, where can we target? Well, I've been looking up toward this peak here at 1745, and then beyond that up to this area here at 1772. One of the factors that kind of have been influencing gold recently, and not just the weakness in the US dollar, the recent weakness in the US dollar, as in the last 3 or 4 days, has also been bond yields. Gold doesn't pay any dividend like how a share does. Gold doesn't yield any interest in a bank account, and gold doesn't pay any interest like how you receive a coupon on a bond. It doesn't receive any, but it doesn't pay out any cash like how a bond would. So in the last few weeks and months, we've seen a rise in US government bond yields. Like I said, the 10-year yield used to be around 3.48%. Now it's dropped below 3% again. Traders and investors are now thinking, where do I place my funds? If it was all well and good, say a year and a half ago, 2 years ago, when interest rates and bank accounts was basically zero in the US, and the US 10-year yield was extremely low. It was almost zero. You may as well have had your cash in gold. That was the attitude of some investors. Nowadays, they're going, well, we're seeing weakness in stock markets because it was only a few weeks ago we saw the US 500 at a 18-month low. We're now in a period of higher rising interest rates, so therefore can actually earn some interest from cash sitting in a bank account. And second of all, we have the US 10-year yield thereabouts at 3%. So whenever you see kind of periods of the US 10-year yield running high, say above 3%, 3.2, 3.3, and so on, sometimes you see a bit of weakness in gold because people would rather have their funds in government bonds rather than gold. Conversely, if you ever do see declines in government bonds, bond yields rather, that's also a time when you typically see gold move higher. So if you trade gold, it's always worth a while keeping an eye on what's going on with yields. Coming on now to the DE30, the DAX, the German stock market. Well, obviously, the higher interest rates typically puts pressure on the domestic stock market. So the ECB hiked interest rates. This could set the ball rolling for further rate hikes from the Eurozone. With that in mind, companies and individuals in Germany that have debt are probably going to be paying more for their debt, because of the higher interest rates, and this could easily be the beginning of a hiking cycle for the European Central Bank. Here in the UK, there's been 5 interest rate hikes since December last year. Since March of this year, we've had 3 interest rate hikes from the Federal Reserve. A 4th is due in a few weeks' time, and there's also talk of another large hike in September. So this is the kind of the steps that the ECB took today. It's probably just going to be the beginning. So if we're coming into a period, a country like Germany is already in a period of inflation, high inflation. Inflation's at Inflation in Germany is already at a multi-decade high. It's retreated a little, but it's still at about a 40-year high, 42-year high. Cost of borrowing has risen today, and it's probably going to keep on rising in the months ahead. That's going to add to the fears: is the German economy going to slow down? What's also an issue as well, hanging over Germany, is its energy security. About 55% of German gas imports come from Russia. In the last couple of days, we've had shortages or a halt in Russian gas coming into Europe as a whole, but in particular Germany. That gas pipeline has kind of resumed today, but there are fears that as we come into winter rather, there are fears that there could be gas shortages. There may not be, but nonetheless, it's a level of insecurity and uncertainty that's hanging over the German economy. Look at the price action in the DE30 in the last few days. We can see we've enjoyed a fairly decent rally in the past 4 or 5 days. The peaks that we saw yesterday were back up the levels last seen in in mid-June. So we're talking about a one month high was posted only yesterday. We've retreated a little today. Higher interest rates in the ECB. It's not really a surprise that we closed a bit lower on the German market, but nonetheless, we're holding above all three simple moving averages. While we continue to hold above all three moving averages, it's likely the medium-term upward trend will continue. A further rally from here could see a target 13,673, and a break above that could see a target 14,046. Looking at the trend on the very short term, we can see it has been moving lower. We saw a lower low, a lower high, and a lower low. So we have seen a bit of a pullback. Looking at the RSI, that's moved lower as well. Essentially, you can almost view the RSI, look at its own kind of price action and trending and trend performance as itself. We can see it enjoyed a large rally here, which coincided with the upward move in price, and then we can see the market moving lower here, coinciding with the move lower in price. We can see in the MACD indicator, momentum has swung from positive territory to negative territory, indicating that the bears are now in control. The sellers are now dominant. If we do continue to move lower from here, where can we target? Well, potentially this moving average here, the 50 period moving average. It acted nicely as support here. It acted as support here, actually as resistance along here. Sort of acted as consolidation here in early July. And what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. And that comes into play just shy of 13,000. And then below that, we could look down towards this low here. Essentially, this kind of trough here, this kind of support zone here before the market jolted higher yet again. And that comes into play around 12,822. Just coming on now to WTI, to US oil, and then I'll kind of throw things open to any questions anyone has. So looking here at US oil, we can see that the longer term trend of the last few weeks has been to the downside. So we had a multi-month high. It was set here in June. It was a 3-month high. Highs that we saw here in June was a 3-month high. It was not too far away from the peaks that was seen in early to mid March, not long after Russia invaded Ukraine. But since then we've been moving lower, and kind of the definition of a downward trend is a series of lower lows and lower highs, which is precisely what we're seeing here. So we saw the lower low, lower high, lower low, lower high, lower low, lower high, lower low. We had a fairly decent rally here. We managed to clear this peak, but we didn't get anywhere even near retesting this peak. Then we moved lower yet again, tumbled down to this area here, which was I believe is a 1-month low. Had a bit of a rebound here. The peaks that we saw here didn't get anywhere near to retest this peak here. Then we tumbled only during the week, where we fell to a 5-month low. The very fact we fell to a 5-month low in itself was kind of a sign things are getting worse. It wasn't that long before, and we were only on a 1-month low. Then all of a sudden we're at a 5-month low. And once again, we've had a rally. Notice how the peak that we set here hasn't managed to actually get anywhere close to retesting this zone here, and we appear to be moving lower yet again. So we're below all three simple moving averages. Momentum's in negative territory. The RSI is pointing lower. So it seems to me that a more medium-term downward trend is going to continue. So if we do fall further from here, where can we target? Well, I've been looking down towards 91.60, and then below that down towards 88.31. On the other side of the coin, though, even though the very long-term trend is lower and the very, very short-term trend is lower as well, it's worth noting that the more medium-term trend is higher. So it's struck a quick kind of crude trend line here. The more medium-term trend over the past few sessions is higher. So if we do manage to kind of extend this recent gain here, where can we target? Well, I've been looking up towards this simple moving average here, the 100-period moving average. If you follow it around, it acted as support here, kind of acted as consolidation here in mid-June, acted nicely as resistance here in mid-June. Another example of resistance being coming into play here. Didn't quite get to retest, and even actually acted. It didn't quite even retest that resistance zone here, but notice how it kind of shied away from it. It's almost like people who were long oil going into while the market was rallying, it didn't even want to hang around for it to kind of retest that moving average before closing out the long positions. Or it could be a case of short sellers coming in and actually wanting to aggressively open short positions even before the market gets to the 100 period moving average. So, but if you follow that around, it's sort of, it didn't even, it got close to retesting as well along here. So I think that the metric clearly has been of importance in the past. I think there's a good chance it could act as to be of importance in the future. That comes into play around 99 spot 92, just shy of $100 per barrel, which of course would be a big psychological number. If US oil fails to break above that moving average, I'll be looking then. If oil does manage to break above that moving average, I'll then be looking at this peak here in around 102 spot 75. And if we go beyond that, I'll be looking to this peak here, the peak of early July, which comes into play in around 109 spot 50. So looking towards 102.75 and then 109.50. Any questions about the material that I've covered so far, or are there any markets that I haven't looked at that you'd like me to take a look at? For those of you who are on Twitter, I'll just give a shout out to FX Pesa. Feel free to follow the FX Pesa Twitter feed at FX Pesa KE. Also, feel free to get in contact with myself at @dmadden_equity is my Twitter handle. Now, obviously, I can't or won't give you any advice or trading ideas, but I'll happily provide any kind of commentary or analysis that I can. But obviously, it will be fitting inside our my company's compliance procedures. So I would never give advice, but I can provide a kind of commentary analysis like what I'm doing today, is talking about the prevailing trend, talking about the news, and say if the trend were to continue, we could target X and Y. If the trend was to reverse, we could target price points A and B. Just got a question here. Would you explain the concept behind the market testing highs or lows? I usually hear it a lot. Sure thing. Ultimately, if you're this kind of for the individual who asked question about the concept behind market testing highs or lows, I would definitely read about technical analysis and the study of trends. You don't even have to get too in depth about indicators and oscillators. To be honest, I think actually they're very much secondary. For me, price is absolutely king. As far as I'm concerned, price tells you about 90% of everything you need to know about which way a market's going. So if you take a look at the just follow the price action itself, and I'll switch to a daily chart to make it simple. Always be asking yourself, what is the market doing? And an upward trend is defined as a series of higher highs and higher lows. So the highs are getting higher and higher and higher. So when you talk about testing highs, if a market's breaking above previous highs, be it highs of the last few hours, the last of the intraday session, highs of the week, highs of the month, multi-month highs, multi-year highs, multi-decade highs, all-time highs. If the market keeps if the highs keep being clear and going higher and higher and higher, that's a sign the market is getting stronger and stronger and stronger. So a simple kind of view of this price action here. If you follow this is a daily chart of US oil. Look at the price action here. We can see the market rallies here to a peak. It has a pullback because, let's face it, markets don't move in straight lines. It's quite common to go from, say, for example, 100 to 120, and then pull back 10 points to 110, then rally 20 points more to 130, then pull back another 10 points to 120, and then from 120 jump to 140, pull back to 130, so on and so forth. And then if you just apply that kind of simple upward trend to a real life market, you see the market trends higher here, it pulls back, gradually moves higher again. Once it breaks this peak here, it then really takes off. it's a new high here, has a bit of a pullback, kind of rests, moves higher once again. Once it clears this peak here, this was the big level. And notice how our market, after it's pulled back here, it then kind of trades in a small range. It's almost as if the market's kind of unsure of which way it's going to go. And then whenever some people kind of have the guts, I guess you could describe it, to actually go out and buy the market and drive it higher, once it actually finally breaks this peak, it then really just takes off. So it's quite almost like timid and kind of almost scared of the previous peak. But once it breaks above, once it finally breaks beyond it, it just completely kind of like lets rip. And I know we've had a couple of small pullbacks along here, but you arguably had one massive upward move to this peak here. Then we add a bit of a pullback, as markets do. To be fair, this pullback was reasonably large, and it cleared this low and it cleared this low, but didn't go back all the way. It didn't go back all the way to this peak here. Similar situation. Then the market has a higher high, higher low, higher high, higher low. Powers ahead here once again. Very similar situation. This level here would have been a big level to watch out for, as we now know. The market's creeping higher toward this peak. Once it finally breaks this peak here, it then powers ahead. So this is what I mean about clearing highs. If the market continues to hit previous highs, you can be looking at highs of the day, highs of the hour, highs of the day, highs of the week, whatever it is. If the market's doing that, that's usually quite a clear indicator that the market's in this case, an upward trend. And then obviously, if we're talking about clearing lows of the day, lows of the hour, lows of the session, lows of the week, lows of the month, all this sort of thing, that's a sign that the market's typically a sign the market's moving lower. I would strongly recommend, if you're interested to hear about that, reading about technical analysis. John J. Murphy has a great book on technical analysis. I believe it's called Technical Analysis of the financial markets. John J. Murphy is his name. Type in technical analysis into Google, and even just basic trend following patterns. What's an uptrend, what's a downtrend, what's a range, this sort of stuff. Very, very simple, very straightforward stuff. It'll be covered in that. What's your take on pound dollar? I'll come on to pound dollar now. Any of the questions? Because I look to wrap things up. Otherwise, if there's no other questions after pound dollar. So pound dollar in the kind of longer term view. Speaking of, for the person who asked it, I'm looking at pound dollar, but speaking about to the person who asked about lows of the retesting lows. Look at the price action of pound dollar. You have a lower low, a lower high, a lower low, a lower high. If you look at all the lows, the low here, had a bit of a rebound, the low, the low, the low, the low. You can clearly see a trend of lows coming into play. And this is the similar. This is the other side of the coin. I keep hearing markets retesting highs. If you're retesting and breaking lows, that's a sign that the market's getting weaker and weaker. So on that note, the big picture view for GBP USD into the downside, you can just look at the price action. Every time I look at a chart, whenever it's a 5-minute chart or 1 hour or 4 hour, a day or a week or a month, whatever, I'll always ask myself, what is the market telling me? Which way is it going? Not a case of what do I think is going to happen? What's the oscillator showing me? What are the indicators showing me? Look at the price. What is the market telling me? Which way is it going? The big picture view is lower because I look at the charts all the time. I know that this low that was set here was a low of 2 years and 3 months, 2 years, 3 months, 2 years, 4 months. So we're talking about over a 2-year low. So the kind of big picture view for pound dollar is weaker. There are concerns about the health of the British economy, that it could be on track for recession. There are concerns about the health of the US economy, but there are even more concerns about the health of the British economy, hence why pound is that much weaker against the US dollar. Fair enough, we had a fairly large rebound here, and we cleared this peak here, but we didn't clear this peak. And as I said, markets don't move in straight lines, and even trends don't always going to fit in perfectly, whereby, every now and again, you're going to have a very large pullback. We had a very large pullback here before we began the next leg of the trend. We had a reasonably large pullback here before we began to move lower once again. And it's possible that the highs that we saw here it's possible that the kind of the peaks that we saw here that didn't clear this peak here, the fact that it didn't clear it, that could be the early indication, the early warning that the market isn't going to break above that peak, and therefore is going to move lower, which we did manage to see in this 24-hour period here. So as far as I'm concerned, GBP USD, we didn't clear this peak here. We're back below 3-7 moving averages. Momentum's in negative territory. The RSI is moving lower as well. So I think I wouldn't be surprised in the near term if you see further losses from here. I've been looking at potentially kind of retesting this area here in around 1850, and then below that down toward this low here in around the recent low, the kind of 2.5 year low of 1760. Just a quick reminder here. Here is my handle on Twitter at @dmadden_equity. So if any questions, anytime you want to ask what's going on in the markets, or any kind of anything you want to ask me about, like, what you make a pound dollar or whatever it is, feel free to get in touch. I see that there are no more questions. I'll look to wrap things up there. So everyone, thank you for your time. I appreciate you you hanging on. Shout out to the couple of questions that were asked. It's always a bit more fun whenever I'm asked a couple of questions. It keeps me on my toes. So we're speaking now for over 40 minutes. I'll look to sign off now. So once again, everyone, thank you for your time. Have a good evening, and feel free to tune in next week. Thank you very much.